What if you could build a portfolio that doesn't just pay you rent money every month, but actually grows significantly in value while doing it? We're talking about the holy grail of investing, growth and income. And today I'm breaking down my top 8 ETF picks that are crushing it right now. We're looking at funds that have delivered impressive total returns, many soaring well over 10% in the last year, while pumping out serious cash flow. We've got some everything from the income monsters, the yield double digits, to the core defenders that sleep well at night. And yes, we cover specific payouts and risk and why these E8 made my list. Hey guys, welcome back to the channel. I'm Doug, the retirement guy, and we're going to dive deep into this. We're going to dive deep into the top 8 monthly ETF funds for growth and income. Now, before we go any deeper, I gotta just give you guys a pre-warning that this video is really for educational. I am not a financial advisor, so past performances don't guarantee any future results, and this is for educational. If you need financial assistance, always contact a financial advisor or professional. So we're gonna start off with the strategy for the growth and income. Building a portfolio that pays monthly, like we call rent money, while significantly growing in value. So many people look at these things when they start to build a portfolio, they're looking for yield, they're looking for returns, they're always just looking for that big income package. Well, we targeted funds with total returns that exceed 10% annually and higher. And the key strategies and the parts that we use, if you've seen my other videos, this is basically a 3-bucket system. This is an aggressive income, which is focused on maximizing cash flow right now. And these income monsters may use leverage, options to bump out double-digit yields, and often pay monthly. Now, the quality growth, the balanced funds that hand-picked high-quality stocks, they offer steady dividend growth and solid price appreciation with lower volatility. And then we have what we call our core stability. This is the foundation of the portfolio. These are the core defenders, providing long-term stability and consistent total returns that rival the broader markets. When you put these 3 together, this is what gives you the solid core portfolio for retirement that you can count on for growth and income. Let's first talk about the monster income package. This is the maximum yield and monthly distributions. Now, these are not suggestions. These are just funds that I personally picked, and I put them in there for particular reasons to give you an idea that how to build an income monsters in a portfolio. So the primary objective is designed for investors seeking immediate aggressive cash flow. These funds use leverage on advanced strategies to generate high yields that are typically distributed on a monthly basis. So the 3 funds that we use, HDLB is a 2-time leverage income. We're going to use the QQQH, which is the NASDAQ hedged equity. And then we're going to use the NDIV, which is the natural resource income. So our first fund, HDLB. The Yield Beast. E-Trax monthly paying 2 times leverage U.S. dividend low volatility ETN. Now I know this is an ETN and not an ETF, but it mostly invests in large cap equities, and the fund tracks 2 times leverage the exposure of the index, compounded monthly, of 40 stocks that have been basically filtered through from a list of 1,000 U.S. firms based primarily on high dividend and low volatility. So this fund pays out monthly, and it uses that leverage to amplify its returns. And why is it in our list? Because it delivers that eye-watering double-digit yields in strong bull markets. Price returns can exceed 20+%, and making it a powerful engine for both growth and income. Total return numbers are currently 41.76%. This is a win-win situation. The catch, The high reward comes with high risk. Because of that two-time leverage, in the market dips, the fund dips twice as hard. It is an ETN, which carries some credit risk of the issuer. And the performance profile, it's ideal for aggressive investors who can stomach the volatility in exchange for maximum monthly cash flow and significant upside during market rallies. When we look deeper into this fund, it's $5.24 million. It's been out since October 24th. Expense ratio 1.65, total shares 320,000 shares. That dividend, a 10.56% dividend, paying out $1.84. But look at the growth. The fund has grown 25.71%. Over 1 year total return, 41.76%. And that's not the half of it. Look at the 1 month, look at the year to date. So we're basically a year, 1 month and 5 days into it. 16.98% growth. This thing is rocketing because of the way the volatility is in the marketplace. 5 years out, 19.35. So this is not a fund that's just a flash in the pan, something hot today. Since inception, 5.91% total return, but over 5 years, you're averaging 19.35, and 1 year, 41.76. This is a win-win situation, and it's the best unknown value out there. I think once people hear about it and start understanding this, and even though it's already 6 years old, this thing is just a quiet little fund that's just going to continue to go and go. So now we go to QQQH, the tech giant. Now the NEOS NASDAQ 100 Hedge Equity Income ETF. Now I know right off the bat everyone's going to be looking at this and saying, why didn't you just go with QQQI that pays out better, does everything? Well, here's the thing. Remember what we're looking for. We're looking for growth and income combined. Okay, we're going to get the advantages of that QQQ, but we're going to give some hedging to it. We're going to give some downside protection in our portfolio. We're still going to be able to capture the growth of the tech giants like the Amazon, the Microsoft, Nvidia, and we're going to use option strategies on the NASDAQ 100 to generate monthly income. But we're also going to hedge us to protect the investors on the downside during market volatility. So why is it in here? Well, again, it delivers income and hedges our protection for investors on the downside market. Yield 10.19%. Not too far off from what a QQQI is cranking out. You know, what are we, maybe 4 to 5% difference between the two? But we don't have any downside protection of QQQI. That's why this is used into the part of the portfolio. When we look at this, now this fund here, it did have a slight drop off at the time of this viewing, which is probably hurts the presentation as the most, but look what this thing has done. Okay, its growth 0.19%, 9.17% income for a total return of 10.19%. $360 million in assets, $4.83 in dividends. The dropped off was big in April 2nd, but recovered very, very quickly and all the way back to where it once was. Since inception, this is another fund. It's been out since 2019. Since inception, it's averaging 10.36 per year of total return. 1 year, 10.19. Now, the year starting, we're only a month into it. Yes, we're only off about 1%, but this is a time that this was a fund that will be part of our portfolio to give us downside protection, growth, and income. Now, NDIV is the yield beast, the amplified natural resource dividend income ETF. Now, Amplify uses this. It's a stock based on particular theme. It tracks 40 to 60 U.S. listed dividend paying companies engaged in the natural resource industry holdings. And it's selected for the fundamental factors and weighed by their dividend yield. It holds the energy and material leaders like Exxon and Chevron, writes covered calls to boost the yields and smooth out the sector volatility with capital appreciation potential from rising global energy demands. Well, we put it in here because it's a totally different market. We're not S&P 500, we're not NASDAQ, we're not Dow, we're not Russell, we're not looking at tech, we're looking at energy. The yield of 10.50, which is total return. And then we have that the reward comes from the higher risk, but also has that global politics as an issue. And this is ideal monthly cash flow. Let's look at behind the scenes of this one. $18 million in assets. It's been out since 2022. The growth of 3.93%. Income 4.94% for a total return of 10.50. Now here's the thing. We're not looking for those home runs. We're not looking at those 10, 12, 14% income barriers. What we're looking at total returns. How is it going to do long term? And this one here, I'm telling you right now, look at these numbers. Since inception, 11.8% average. 1 year, 10.50 total return. Year to date already, it's up 15%. And 1 month, it's already up 13%. You're not getting that in dividends, guys. You're getting that in pure hardcore growth. So 2026 already looks like this is going to be a big year for NDIV. Now we get into the quality growth. This is the group number 2. This is the midfielders. This is where we get the balance upside and still some income. So we were looking for heavy income on the first section. And you can get more aggressive on group number 1. I'm not saying you can't. What I'm saying is I'm giving you a plan that's aggressive, but also conservative as if you're getting growth along with income. The growth quality, the premium objective of this part of your portfolio. These funds provide a sophisticated balance of dividend growth, price appreciation, and it's being filtered by the quality and utilizing active management. They offer monthly paychecks with significant lower volatility than aggressive income strategies. So why do I get excited about this? Well, it's coming into the point where we're building a retirement portfolio that we're not looking for home runs. We're looking for singles. We're looking for consistency. We're looking to be able to sleep at night and not worry about a single thing, but still pay our bills. The first fund is going to be DIVO, the enhanced dividend income, and then the small cap quality growth of DGRS. Again, these are not suggestions. These are not go buy signals. These are just funds how I would build this portfolio across the board in most markets. So DIVO, $6.29 billion. Okay, huge fund. 136 million shares outstanding. Pays a $2.88 distribution, which is 6.21%. But when we take a look at the growth, since after May 2nd, it hasn't stopped. It's gone all the way up, 9.33% growth already. So since this is in our growth section, this fits very well with a 1-year total return of 16.81%. But the nice thing about it, this thing's been up since 2016. We're looking at an inception of 12.97%, 5-year average 12.84%, 1 year 16.81%, year to date 4.73%, and 1 month 4.27%. This is one that you have in your growth. You're not going to hear about it. You're not going to be sitting there saying, oh, the income is phenomenal. This is the boring stocks. These are the boring ETFs that are out there, but they do the job that needs to be done. Great year total returns, good income, good growth. And then that Wisdom Tree U.S. small cap quality dividend growth, again, 7.99% growth. This is a $365 million asset fund, 6.75 million shares. It's been out since 2013. So have you seen the theme so far? So many of these are at least have 5 years of history out there. They have so much time under their belt that we know how has it gone on. We had the April 2nd. This in 2025. We had the November change. What happened in the past? So many of these funds have seen so much history that we know that these things can continue to produce time in, time out. So let's take a look at this one. Now, total return, 11.03. That's 1 year. Over 5 years, their average is 8.25. 10 years, 10.98%. Since inception, 9.17% total return. These are the fundamental bricks that you have in your portfolio that you just count on day in, day out. You don't watch the news. You don't watch your portfolio. These are set them and forget them type funds because they just are always there. 1 month and year to date, 10% and 11%. Again, the funds are doing great recovery in today's markets. So the quality and the small cap growth. Devo is an actively managed, hand-picking 20 to 30 of the quality blue chip stocks like United Health, Visa, Microsoft. The strategy is optimization, selling covered calls to boost the income without capping the upside. That is the huge part. They're not capping their upsides. They're still generating income from covered calls, but they're not capping the upside of the funds. They have a steady 4 to 5% monthly yield, with total returns often beating the value of the benchmarks. We just showed you all that of Devo. And now DGRS, this is our secret weapon. This one targets those small cap companies, historically the sector with the highest growth potential. We use a quality filter. We screen for the earnings, growth, and dividends, and to avoid any risky small caps. And this is what we call the paycheck. It provides that monthly distribution in a sector typically dominated by quarterly payers. So these are very strong funds that I found and put together into our quality of the small cap growth section of our portfolio. SCHD. It's the dividend anchor. Now this is the Charles Schwab U.S. Dividend Equity ETF. This is a fund that is based on the Dow Jones U.S. Dividend 100 Index. It's a market cap weighted index of 100 dividend-paying U.S. equities. Now, this one is in our stability category because this is probably one of the most talked about funds when you talk about retirement, when you talk about your long-term portfolio. Most paid financial advisors will turn to this. I know I've talked to it about numerous times about SCHD, where you need to put your money into it. This is what we call the legend. It's a widely considered the gold standard for dividend ETFs. It tracks the Dow Jones. It focuses on high quality companies with sustainable payouts. Now, they have a strict selection criteria. 10 consecutive years of dividend growth, or you don't even make the cut. Cash flow and total debt ratio, return on equity, and basically the dividend yield that they're looking at. Now, this is I always want to throw it out there, is Charles Schwab is not chasing yield, but they're using it as part of a bigger picture. Okay? So it's not just the highest yield, we're taking it. No, they want 10 years of conservatism. They want cash flow. They want return equity. Then they're going to take a look at you as your dividend and your dividend yield. So why does this one win? Well, the SCH doesn't chase yield traps, as I just explained. It really does a true hardcore screening to ensure that it's holding companies with strong fundamentals. Now, Charles Schwab just did go through a big change on this one. I believe it was almost a year now, last March. They made a big changeover where they eliminated some. They rebalanced their portfolio, and it took a dive, and now it's recovering. But even so, the performance, typically you're getting about 3 to 3.5% historically. It's total return of the S&P 500, making this the perfect foundation for an income-focused portfolio. When we look underneath the hood, this one just gets you crazy. It's $79 billion investments. Okay, they have 2.64 billion with a B shares outstanding. Now it pays $1.05 in dividends. It does pay quarterly. This is the only thing. When we get into these stability ones, We're switching to quarterly. The 3.39% yield. And I'm going to go back to, I'm not a big fan of quarterlies. I like having that monthly as my minimum. But in this situation with the funds that we found, that these are the hardcore ones that we're going to build our foundation on, I'm willing to accept the quarterlies because I'm not going to live off this money. It's just going to continue to add to our foundation. But the growth of the fund, 11.37%. Now, this is what people talk about is 3.39 income, no big deal. I can get bigger. You're getting a 11% growth with a 3% income for a 15.75% total return. So if I told you we're getting 15% from a fund, you'd all be paying attention and saying, who is it? Who is it? Who is it? If I told you you're getting an income of 3.39%, you'd all laugh at me and you'll say I can put my money in the bank and get more off of it. This gives you the best of both worlds. Now we take a look at the history. This thing came out in 2011. So we're 14, almost 15 years into this thing already. So this is what gives you that long term of dialing into it. Since inception, the average return, total return, 13%. 10 years, 13%. 5 years, 11%. 1 year, 15%. And then you take the look at lately, this thing is rocketing. 1 month and year to date, 11.5 and 12.7. This thing is rocketing in anyone's portfolio right now. But overall, look at it. It's a stable rock, and this is what you want in your stability. That you can sleep comfortably, you can go off, your funds are taken care of. HDV. This is the defense shield. This is iShares Core High Dividend ETF. Okay, this fund tracks dividend weighted index of the 75 high-yielding U.S. equities. Okay, their portfolio is heavily weighed towards defensive sectors, with 52% in consumer staples, healthcare, and utilities, and 25% into energy. Look at the chart on the side, what their criteria is. Consumer defense. What is that? Well, it's all the things that you need as a consumer in your operations. Energy. We all need our lights on. We all need gas for our cars. Healthcare. We're all getting older. We all need healthcare. I don't care who you are. You're going to need healthcare. Utilities. Again, you got all the things a part of utilities that need to happen. And then the consumer cyclical. So when you look at this, it's almost like it's what we live on day in, day out. They're banking on. So HDV uses the natural growth and income from stocks into companies that they know for long-term payments. Typically, the yield is around 2.9%. Historically, the returns rival the S&P 500 again. So another one of these that we're going to. So now we take a look at the under the hood part of this. They have $12.81 billion in net assets. Their expense ratio is 0.08. That means basically $8 out of every $10,000 is going to the company. So this is kind of a no-cost type program. 96 million shares outstanding. Dividend, they paid out $3.91 over 12 months for a 2.89% distribution number. Again, as we tell you before, and I'll explain this one more, why I don't chase yields. $3.91. That's 3 times the amount that Charles Schwab's fund pays you. And if the dividend is only down to 2.89, well, this is the thing with percentages, okay? They control how many shares they put out. The price of their shares is tremendously higher at $135 per share, while Charles Schwab puts out billion number of shares. So you have less shares being spread across at 391 gives you a different yield. But look at this thing, 18.04% growth. Now this fund's been out just as long as Charles Schwab. It came out in 2011. It does pay quarterly with a 2.89% income. Total return, 22.03%. So in your foundation portfolio, you have two big guns that are operating, that are creating income and growth to continue to build your foundation stronger, so that if you want to rebalance down the road, you're going to have money that is going to, can go into your income folder to get even bigger income if you need it, but it gives you stability for the rest, for your time in your portfolio. When we take a look at the numbers, since inception, now these are, remember, our total return since inception, which is 14, 15 years ago, 10.65%. 10 years average, 10.32. 5-year average, 12.88. Over the last 12 months, 22.03. 1 month and year to date, both very respectively about 11 and 11.5%. This is why you have these in your foundations. Then we go to FDL, which is the Dividend Leader. This is the First Trust Morningstar Dividend Leader Index. This fund roughly holds 100 securities and excludes REITs. So it's focused on high yield combined with dividend sustainability based on the Morningstar's dividend leaders. You look at their criteria: energy, healthcare, financials, very similar to what we just seen previously. So they're not chasing yield traps. They're chasing companies with long, consistent dividend histories. And this one typically gets you a little higher income, around 4%. So when we take a look at this fund, it's $6.65 billion. Dividend 1.79 or $1.79 with a 3.62 yield. It does again pay quarterly, but we're talking growth, 18.92%. Income of 3.62 for a total return of 23.80. This is one of the longest ones. It's nearly, we're so close to being 20-year-old history on this fund. Since inception, 8.76, 10 years, 11.86, 5 years, 14.97, 1 year, 23.80. Those are all total returns. Almost literally, for 10 years, double-digit averages. And take a look, 1 month, year to date, again, 10.5 and 11.5. So another 3 strong pillars in your foundation mark. So the perfect portfolio mix is you have aggressive income, 3 different funds for maximum cash flows. And again, as I told you earlier, you can swap out certain pieces of this. Your aggressive income, if you need more income than this generates, you can swap things out, put in things that you want to do. This was just showing you of pieces that have growth and income as a combination. Your quality growth funds are balanced and an upside, paying out monthly. And then our core stability. Now I know it's quarterly, but these are your portfolio anchors. These are the ones that are holding everything together. These 3 groups achieve what we call the holy grail of investing: consistent monthly cash flow to cover your expenses and total returns exceeding 10% to build long-term wealth. This system works if you're just getting into retirement, if you're well into retirement, or if you're 5, 10 years out from retirement. The system works across the board. You take a look, and this is why I give you a final scenario of this. Your aggressive income, your growth, about 9.79% average. Your income, about 8.22%. Yeah, I know a lot of people are going to leave comments with this. Is that, well, that's too much growth. I want more income. You're correct. I'm giving a balanced portfolio that's giving you both growth and income across the board. This is the foundation. We can make adjustments all we want. Our total return of our income section is 20.82%. Our quality growth side of it, again, 8.66 for growth, 4.32% for income, for a 13.92% total return. And then our core stability. This is the one, this is the foundation, this is the rock of the piece. 16% growth, 3.3% income for a 16.58% total return. This is how you build a long-term holy grail portfolio for long-term retirement. And I said, I'm going to say it all over again. We can adjust any one of these funds out, make changes, change it to fit you personally, and everyone's different. That's why I always say everyone is totally different. So this is not a platform, follow these 5 steps and you win. We're not saying that. What we're showing you is how to build a portfolio properly. Let me know what your thoughts are. Do you like the way we set this thing up? You probably are going to put some comments. I would put in, QQQI, and I'd put in SPYI. You're right. Those are all good funds, and they can fit into an aggressive income area as long as you have the other 2 sections set up. So let me know in the comments below. Hit that like button if you like the video. We appreciate everything that you guys do and watching our videos.
Thank you for watching. Press the like button, hit the subscribe button, and join. Leave any comments